Hi, I'm Zach Pandal, Head of Research at Grayscale, and this is the macro case for crypto. Cryptocurrencies like Bitcoin and Ethereum are alternative monetary assets based on novel technology called the public blockchain. And to understand how blockchains work, you really need to study computer science and cryptography. But to understand why these assets have value, you need to think about fiat currencies and modern macroeconomic imbalances. Fiat currencies like the US dollar depend on trust. Trust that the government will not unexpectedly increase the supply of money and create inflation. Governments make this commitment, and we all decide whether that commitment is credible. Today, the US government's commitment to ensure low inflation over time may no longer be fully credible. And that has potentially important implications for investors. The reason for this credibility gap is ultimately about high and rising government debt. Over the last several years, US government debt has increased substantially. Back in 2007, it was just 35% of GDP. Now it is about 100% of GDP, nearly as high as the final years of World War II, and it's expected to remain on a steep upward trajectory. At the same time, our ability to borrow money from overseas is running into natural limits. And this is really the key. If we could keep borrowing at very low interest rates, rising government debt would not necessarily be a major problem. But interest rates have gone up, so interest payments on the debt are soaking up more and more of the government's resources, and ultimately this trend is unsustainable. There are essentially two ways forward. The first is fiscal belt-tightening. We could raise taxes and/or cut spending to balance the budget and bring down the debt over time. The second option is just managing the symptoms. We could try to keep interest rates artificially low and potentially tolerate some degree of inflation. Now, no one can be exactly sure how this is going to play out. But given the severity of the problem and the actions of policymakers to date, in our view, the second outcome looks more likely. In other words, the strategy for managing the nation's debt burden will likely involve at least moderately high inflation over time, in our view. Holders of dollar-denominated assets need to decide what this means for their portfolios. If they begin to think the dollar is a less reliable store of value, they may seek out alternatives. And cryptocurrencies like Bitcoin and Ethereum can potentially serve this purpose. As stores of value, their most important features are programmatic and transparent supply and autonomy from any one person or institution. The supply of Bitcoin, for example, is capped at 21 million coins. The supply currently grows at a rate of 450 Bitcoin per day, and every 4 years, the rate of new supply falls by half. This is spelled out transparently in open source code that is not possible to change without the consensus of the Bitcoin community. This idea of transparent, predictable, and ultimately limited supply is a simple yet powerful concept that has helped Bitcoin grow to a market capitalization of more than $2 trillion. Like physical gold, Bitcoin and Ethereum are commodities that can be considered monetary assets. And the purpose of holding these assets in a portfolio is to provide a ballast against the risk of fiat currency debasement. And as long as those risks are getting larger, macro demand for these types of crypto assets may continue to rise. What could turn things around? Well, essentially, if trust in fiat currencies starts rising again, macro demand for crypto assets could fall. For example, if governments pursued balanced budgets, restated their commitment to low inflation, and ensured central bank independence, some of that trust and credibility could probably be rebuilt. For much more detail, see our report on the macro case for crypto at grayscale.com/research.